Okay, hello everyone, this is Jeff here with FX MindShift, and today's webinar we're going to be talking about higher time frame trading and specifically the topic of zone flips. Now this is a very popularly requested topic and today I'm going to go in a little more detail in this so that you guys know exactly what to look for in terms of zone flips. This week I'm going to be going over higher time frame entries. Okay, and then the following week I'll be doing some lower time frame entries and a little bit more precision intraday stuff. So this week we're going to go over some higher time frame concepts. So let's get started. All right, so first what you want to know is how to find the setup, right? What to look for. So what you're going to do is we need to go to the higher time frame, okay, determine the higher time frame bias, and then your entry, okay? Now the bias can be found on the monthly, the weekly, or the daily chart, depending on how long you expect to hold the trade. Okay, it could be position trader, long-term trader, swing trader. That's going to depend on whether you're looking at the monthly, weekly, or the daily for the bias. Okay, so if you're looking on the monthly for your bias, generally you're going to be looking for your entry on the weekly, and this is where you're going to be holding your trades for a very long time. You know, maybe weeks or months at a time for them to play out. Okay, so this would be long-term trading. On the weekly, if you're looking for your bias, then your entry is going to be mainly on the daily chart. Okay, and this would be short-term trading or long-term shorter long-term trading periods or swing trades, right? And then finally the daily bias. If you're looking at the daily for your bias, you're probably going to be entering on the H4 chart or the H1 chart for your entry. Okay, so three different biases, three different time frames, and then whatever you decide to use for your entry, it's going to be affected by how you find the bias. So what we're looking for is a market structure shift or a break. Okay, and specifically in bullish bias conditions, we're going to be looking for relatively equal highs to be traded through aggressively. Okay, and then you're going to watch for price to retrace back to that level that was broken. Okay, and that will be where you're looking for the setup. Similarly and conversely, in bearish bias conditions, what we're going to look for is relatively equal lows to be traded through aggressively, and then watch for price to retrace back to that level that was broken. Okay, so now what exactly do we look for when that happens and when we look for to take an entry? Okay, so I'm going to go over bullish bias conditions first. Okay, and basically we're looking for price because price is looking to be trading higher since we're bullish, right? So we want to see an aggressive shift through what retail would perceive as a strong resistance. That would be, of course, equal highs, right? M's, double tops. Retail is going to look at that and look to sell. But because we're in a bullish bias condition, and we've determined that beforehand, we know that price is going to be willing to trade through that and break those highs. Okay, and we would be looking for a buy entry when price retraces back to that level of the previous resistance that was broken. Okay, you're going to look for the swing high formation that was created just prior to that shift through. You're going to find the highest candle, including the wick. Okay, and then the range of that candle will be your entry. All right. Now, I know that sounds complicated. Obviously, I'm going to show you some chart examples of what that looks like, later on. Okay, but this is conceptually what you're looking at. Okay, so conversely, in a bearish bias condition, okay, because price is looking to be trading lower, we want to see an aggressive shift through what retail would perceive as a strong support. Okay, and that would be equal lows, double bottom W's, right? Price is going to want to trade through those. Okay, and then we would be looking for a sell entry when price retraces back to that level of previous support. Okay, same thing. You're going to look for the swing low formation that was created just prior to that shift through, and then you're going to find the lowest candle, including the wick, and then the range of that candle is going to be your entry. All right, so let's take a look at some chart examples exactly to kind of illustrate what I'm talking about here. Okay, so looking at this here, this is the British pound US dollar monthly chart, okay, and we're going to find a bullish bias on this monthly chart here, okay, with this swing low point right here. All right, now if you guys don't know how to find the bias on the higher time frames, you need to go back and watch the video on determining the higher time frame bias. to figure out, how exactly I'm figuring out the bias, and that we're bullish. Okay, so if this is a bullish bias, this is our swing low on the monthly. Okay, and on this candle right here, okay, you can see that this is the April candle, right? This candle, immediately after this candle is the May candle, and this is where we'll be looking for bullish conditions. Okay, this is where our rules dictate that we can be a bullish buyer in the market. So this is a monthly chart. All right, now what we're going to do is we're going to drop down to a weekly chart for our entry. Okay, so you can see here that here's the first week in May. This is where we determined that we would be looking for bullish setups. So this point onward, we're bullish. All right, now looking at that, okay, you can see that price has created relatively equal lows right in this area right here. Okay, you can see this double top here. All right, now this to anyone would look like an M, look like you wouldn't be selling, and especially with this aggressive move down. This is to induce sellers to come into the market and kind of further corroborate this double top, right? However, we've just determined that we are in a bullish bias condition. So we know that this is probably going to be traded through, right? So these equal highs here get traded through aggressively with these candles here, right? You guys see that? Okay. So highs are traded through. All right, now we're looking for price to retrace back to this level of resistance. Okay, and we're going to look to the left for the swing high that was formed prior to this move up, okay, which is right here, and you're going to find the highest candle, okay, with the wick included. Okay, this is obviously right here, and then you're going to draw a box around that range, okay, and then you're going to wait for price to come back and retrace into this area. Okay, you can see price retraces rather deeply into this zone here. Okay, and you're going to take an entry when price returns back to this range. Okay, now the range is rather large on this candle. Obviously, we're looking at a weekly chart. Okay, so this is going to be a massive amount of pips, however you look at it. All right, but generally, you can look for the price to come back to around the middle of the range. Okay, and look to take your entry there. Of course, there are times when price is going to come back right to the top of it and maybe even down to the bottom like this, okay, and take off. So really the entire range of the candle is going to be where you're taking your entry, and that's going to just, be a personal judgment call on your part where you want to decide to take it, okay? Because sometimes you'll miss an entry when it just hits the top of this box and takes off. Sometimes you'll enter here and then you'll have to sit through all of this drawdown if this happens where we trade to the bottom range of this candle. Okay, so really ideally you're just looking at the midpoint and then taking your entry somewhere around there. Okay, and your stop loss is going to be below this candle right here. Okay, now why this candle specifically? Because this is the candle that propels price away from the resistance area. Okay, so we don't really want to see price come back below this price point. Okay, because if that's the case, then this might be a reversal. Okay, we might not be in a bullish trend. This might be a reversal. We might be coming back down, right? Now, you could be safe and put it down here below this swing low. Okay, that's okay as well. But generally, this is enough. Okay, I feel that this candle, because of the propulsion away from price, you don't want to see it come back to below this area. This would be enough, an area that's good enough for a stop loss. Okay, now this is a higher time frame chart on a weekly. Okay, on a lower time frame chart, maybe you want to put it below the swing low. Right, it'll be up to you. All right, now given this scenario, okay, you have your entry right here, okay, and then this is your stop loss range, okay. This is potentially your take profit, okay, because this is the high right here. This is going to net you a 5-to-1 risk to reward ratio on your trade, okay. So say you're risking 1% down here, okay, your payoff is going to be 5%. 2% risk, your payoff is going to be 10%. Okay, on one trade. Now this is a weekly chart. Okay, so this is of course lots of pips. Okay, the stop loss here is I think around 200 or 300 pips, and then the take profit up here is well over 1,000 pips, maybe 1,200, 1,300 pips, something like that. But you're looking at a weekly chart. Okay, so that's obviously expected, and the time that it takes for this setup to play out obviously is many months, right? Obviously because it's a weekly chart, and you're looking at your bias on the monthly. Okay, so this will be a long-term trade, okay, that you take on a higher time frame. All right, so now let's look down and look at a weekly bias. Okay, so this is pound dollar with a weekly bullish bias. And we're just going to, obviously we could look at any of these swing low points, okay, but we're going to look at this one right here in the middle. Okay, so this swing low formation, okay, we can be a buyer after this candle right here, right? So this candle is August, the end of August. So we're looking at probably the beginning of September is when we're looking at a bullish bias condition. Okay, so let's drop down to a one daily chart. Okay, and look for our entry. Okay, so looking at this right here, here's our line. This is where we said that we would be looking for bullishness. Okay, after August into September, this is the first week of September. Okay, so here after this, we're looking for bullish conditions, and we're looking for relatively equal highs. Okay, so where does your eye go? It should be going right here. Okay, you can see here relatively equal highs made right here. Okay, in a bullish uptrend, these kinds of moves here are put in there to fake out the retailers, right? Give you a nice M structure here, make you think it's going to be selling. Okay, but you can see here that right afterwards, these equal highs are taken out by this price move right here very nicely, right? Nice aggressive move to take out those equal highs. All right, and then now what do? We look for price to retrace back into that area. You're going to look for the swing high formation prior to the move up, find the highest candle with the wick, and draw a box around that range. Okay, price is going to come back, retrace into this area, and that's where you're going to take your entry. Okay, now you can see in this example, price retraces to the top of the range, right? We don't get to the middle, we don't get to the bottom. So that's why I said that the range of the candle, the entire range is going to be, fair game for an entry. Okay, now sometimes you'll miss it when it does this if you're waiting for it to come to the middle. So you have to expect that there's situations when this happens as well. Okay, so this is your range for your entry. Your stop loss is going to go right below here. Okay, because this candle is the where price propels away from the double top up here. Now, like I said, you could put it down here below the swing low to be safe. Okay, but you don't really want to see price come down that far in any case. Okay, so you probably want to kill the trade before that happens. All right, so there's your stop loss. Okay, and if we're taking the trade here, and your stop loss is down here below this swing low right here, or this right here, this would be your risk. Okay, here is your potential reward. Okay, TP up here at the highs. Okay, you're looking at a 7-to-1 risk to reward ratio. Right, so you risk 1%, you gain 7 on this trade. Okay, risk 2%, you gain 14. Okay, and this is on a daily entry. Okay, and you're looking at look at how long it takes for that to set up. It's about a month. Okay, in time for that to set up and to play out, right? So that's a little bit shorter than what we were looking at earlier in terms of monthly and weekly, obviously, because this is a daily chart. So this would be like a swing trade or short-term trade that you're looking to take. Okay, now let's look at a daily bias. Okay, this is the euro dollar. Okay, where we're looking at a bullish bias on the daily, and just going to take a look at this swing low right here. Okay, and we're going to be a buyer. Okay, on this candle right here. Okay, so this is about July. We're looking at about first or second week into July. Okay, we will be a bullish bias condition. We'll be looking for buys. So what we're going to do is drop down to a daily chart. Oh, sorry, this is an H1 chart because that was a daily bias. Okay, now with a daily bias, you can be looking at an H1 for an entry or an H4. Okay, and I'm going to show you examples of both here. Okay, but we're going to look at an H1 first. Okay, and this is the area where we said we were going to be looking for bullish setups. So immediately your eyes should be scanning for equal highs. Okay, and lo and behold, we have right here. Okay, nice equal highs, right? You see the high there, basically at the same level. Okay, and then a nice illusion of a downtrend coming up, right? So nice double top up here. Price comes through these equal highs and trades aggressively through them with this big move right here. Okay, and then what we're going to do is all the way up the top here, we're going to wait for price. You can see the price has moved away, and if this happens, you're probably thinking, oh man, I missed the move, I missed the setup, right? Not so, right? You can wait and price will come back and retrace to the area. Not always, but you know, this is what we're looking for. These are the conditions that we want to see, right? Price comes back, look for the swing high prior to the move up, okay, with the highest candle right here, and draw a box around that range. And then you're looking for price to come back into that range. Okay, this is where you're going to take your entry. When price comes back to that range, your stop loss is going to go right below this candle right here. Okay, and as I said, this is an H1 entry, so you could put your stop loss below here. Okay, to see if price does trace back that far. But this is, like I said, good enough for an entry. All right, or sorry, for a stop loss. So this is your stop loss. You take your entry here. All right, and on this trade, if you were to take your entry right here and your stop loss is this range, okay, potentially your profit is going to be this range up here, okay, and if it continues higher, we don't know, but this is the section of the chart that you're looking at, right? So that already is a potentially 8-to-1 risk reward ratio. So 1% risk nets you 8% gain. Okay, this is a 1 hour chart, and this is only within 1 day, right? So as we're scaling down, this is getting shorter and shorter, right? So this is your risk reward, your 8-to-1 risk reward ratio on just one trade. Okay, looking for setups like this to play out. Okay, now we're going to look at some bearish examples. Okay, so I've been showing you bullish examples, but let's take a flip side and look at the bearish examples of how this can play out as well. All right, so we're looking again at the daily bearish bias. Okay, this is euro dollar. All right, and we're going to look at the swing low right here. Sorry, the swing high right here. Okay, to find our daily bias short. We could be a seller after this candle right here. So this candle is at the end of August going into September. Right, and we'll drop down to an H4 chart this time. Okay, so H4 entry, we're looking for bearishness, and then we're looking for equal lows. Okay, so where do I see equal lows on the chart? Right here. All right, nice set of equal lows in a nice bearish downtrend. Okay, you can see price trades through these equal lows very aggressively with this big shift candle right here. Okay, and then what we're going to do is we're going to wait for price to retrace back to those equal lows. We're going to draw a box around our swing low with the lowest candle right here, with including the wick. Okay, and that is going to be our trading range. We're going to wait for price to come back and retrace into that area. Okay, and you can see actually this one stabs a little bit through the range. Okay, but our stop loss is going to be just above this shift candle right here. This is the shift that takes the price away from these swing lows. So your stop loss is going to go above this swing high. Okay, so there's your stop loss. There's your entry. We're going to take the entry when the price comes back to that range. All right, and then potentially this trade is going to net you, okay, with a stop loss of this above this swing high, the entry here. Okay, and then your take profit is going to be down here. 3-to-1 risk reward ratio. Okay, so now this was a larger stop loss. So your entry was here, stop loss is here. Look at the box is a little bit bigger, right? Because of we had to take it above this big shift. Okay, so the payout is a little bit less, but it's still 3-to-1. Okay, it's still a very, very good trade in RR based on the setup. Okay, and this is an H4 entry. Okay, so this took a little bit more time to set up, looking at the end of September into the first week of October. So probably a few days for this to play out. All right, let's look at one more bearish entry example, so that you guys can see that. All right, so this is again the daily bearish bias on the euro dollar. All right, and we're going to be looking at this swing high right here. Okay, and then we can be a seller, okay, right after this candle right here. This is the middle of April, close to the 2nd or 3rd week in April, that we're going to be looking to be a bear. Okay, so that swing high right there, that gives us our bias. So now we drop into a 1 hour chart again, okay, and we're looking at the 3rd week of April, April 20th. Okay, this is where we were looking to be a seller. Okay, now following our higher time frame bias in our trend, we're looking for what? Equal lows, right? So I see there's a set of equal lows right about here. Okay, you see that right there? Nice equal lows, okay, that is aggressively traded through subsequently on the next few candles, right? Trade right through that, okay, and then we wait for price retracement, right? So from here, it starts to turn around, comes back up, retraces right back into this range. Here's our swing low prior to the move down with the lowest candle and the wick right here. This is our range, right? So we draw a box around that range, wait for price to come right back into that range, okay? Now this is the candle that shifts through, that starts to shift through that price. So our stop loss, if we take an entry here, our stop loss is going to go right above that, okay? Now, as I said, you can also put it above this swing high. That's fine, okay? But this should be sufficient. All right, so there's your stop loss. There's your entry. Okay, stop loss, entry, potential take profit. This whole big range down here, right? And that again is a 7-to-1 risk to reward ratio. Okay, so very, very nice payouts with these trades when they play out. And you know, it's just a matter of waiting for these to set up in the correct conditions, right? We want to have a proper higher time frame bias determination, okay? And then you're going to want to look for specifically what swing highs or swing lows to be traded through aggressively. And then you're going to wait for a price retracement back to that area that you've marked off, okay? And then you're going to get a nice risk to reward ratio if it plays out. Now, is this going to work every time in every situation? No, of course not, right? And of course, you're going to see that there's variables to where the price enters and where the price is going to react. Sometimes it's going to be at the top of the range, sometimes at the very bottom of the range, sometimes in the middle of the range, okay? You're going to have to test this out and backtest this on demo to see for yourself. And then once you get enough confidence, you can go on to trying this out in the live charts and seeing how you fare, okay? So I hope that was helpful, guys. As I said, next week we're going to be delving into this a little bit more deeply in the intraday level, looking at more precision entries. Okay, but if you have any questions on this today, specifically on the higher time frame stuff, would have asked you to send me a message on Telegram or in the chats, and I can get you squared away. All right, guys. So hope that was helpful. I will see you guys on the next video.